Good afternoon, everybody. Welcome to your Friday weekend edition of the TraderMerlin Show. Lots to talk about on today's program. I'll be able to go a little bit long today. I know yesterday was a short one, so thank you guys for the patience. Hope you enjoyed that one with Bill Addis yesterday. That was a great show. I always love having that guy on. So it is Friday. Cheers to all of you out there. Hope you had a great trading week. I know that we had an about face in our markets, but a damn good week for my accounts. I'm pretty happy about that. Okay, so let's dive right into it. I had the graphic here showing a bit of a rejoicing. If we could zoom out on that picture a little bit, it was I told AI to create a ticker tape parade on Wall Street with people celebrating. You know, you wouldn't know that we've had a bad week overall for most of the major markets. Scratch the NASDAQ. I'll show you guys all that different time frames here in just a second. But given the jobs data that came out today, all of a sudden everybody is just like, oh, wow, this is it. I'm hearing so much incredibly optimistic talk track about one data point. All right, so that's non-farm employment change. I'm going to start there looking at the data just so you guys can see this one. And this had people losing their collective minds. It was ridiculous. We were supposed to go from 227,000 jobs down to 171. So they're expecting a 50,000 job contraction, roughly 50,000. Instead, we actually ended up with 110,000 gain. A lot of jobs being created, which is great, right? It means it's a sign that people, our employers anyway, are looking at expansion, maybe bring on some more employees. That's actually a really good sign. Here is your chart of this. I will zoom out a little bit because obviously this giant drop that we saw in 2020 skews everything. But you look at it and, okay, fine, great. I just don't see what all the hoopla is about. It beat expectations, great. But does that mean that this is all over, that the weakness is done, that there's economic problems ahead, that we've got yields surging and dollars surging? And it just seems to me like this is kind of a bit overdone. And then when I look at a number that might be just as important, or at least in my mind more important, because you don't hear Jerome Powell saying non-farm employment change numbers. He says unemployment numbers, which means that's what they're looking at. Well, here's our unemployment data, which came out today, worse than expected. They're expecting it to actually decline from 3.8% down to 3.7%. We came out at 3.8%. So we're still holding this higher unemployment number. I actually thought we would see it move up to 3.9, but I'm wrong again. It's okay. I will take it for what it is. So this is kind of what the markets are rejoicing about. When we look at the end of the week, I will run through what these markets did for the day, but let me just real quickly show you the weekly returns. So the final candle you see on the right-hand side of your charts, that's the weekly. Obviously, the Russell putting in a very ugly week. The dollar index, probably the most noteworthy one of the week. I'm going to come back to this one, but we have a massive shooting star on the weekly on the dollar index. We'll definitely have to take more note of that one in just a second. You had crude oil got slaughtered this week. All right, fine, that's good. You had gold, second week in a row of kind of getting beaten up. Here's your Russell 2000, which had a great bounce off the bottom, but still all in all a fairly negative week. It's been a couple of just brutal months, much to my joy. S&P 500, you have a dragonfly doji here, so we can talk about the weekly potential upside here on the S&P 500. You had the dollar index, the 10-year continuing to surge, and the NASDAQ was your outlier this week because it was actually up. A lot of these other indexes were down on the week, and of course, then there's Bitcoin, which had a nice weekly run as well. So, all in all for the week, there are a couple really interesting pieces that to me might create some opportunity for next week. Now, my trades today were, actually, they didn't go through. I had an order to close out the second or the third portion of my put position on the IWM options, and I had an order in there at 737, the price strike price or the price of 737, and we got to 710, maybe 717, somewhere there. Got close to it, and then just started to rip up. And it's a bummer because if you look at this IWM here or Russell, let me bring up the intraday so you guys can see the craziness that happened there. I mean, it was falling apart early. It double dipped. And right in here, I was like, oh, here we go. I'm going to get filled, be out of my position, be done with it, enjoy my nice weekend with a flat position going into the weekend. Well, I'm still holding 20 puts. I should have closed that out. Gave back a lot of gains. At one point, that position was up significantly this morning, and now as far as day gain goes, gave it all back and ended up losing a couple grand on the day just because of that one swing right here. Pretty crazy the way that when you have size, you can get big swings in your account balances intraday. So I'm still holding that in the weekend. Not that happy about it, but let's look at a couple different factors here. And before I dive into this, I do want to mention, I did post on the Twitter feed, but I know some of you have been asking. I will be on the Don Franz show today, right after this, 3 o'clock. So this show goes from 2 to right about 2:45 or something. I'm going to wrap things up right around 2:45, and then I'll go join Don Franz on his channel to talk markets, do something fun. Who knows what we'll be talking about, but it's always something fun with Don. So we'll do that at 3 o'clock today. Again, bring your questions to either chat room. It's fun when Don and I have a chance to go back and forth because we don't agree all the time, and that's what makes it fun, is we treat each other with civil discourse, even if we disagree, but a lot of times we actually agree on things pretty spot on. So and that'll be in another, almost 50 minutes. So let me go into the two pieces that I'm really interested in for Monday. If I go back to this daily time frame here, and we've had this head and shoulders pattern on, it still could potentially come true. We got fairly close, right? The low point on the rut was 1720. My target was 1650, which is the lower end of this giant yellow box that you see. But I've been peeling off part of my position on the way down there just because I don't want to be greedy. This move that we've had in the Russell since I opened this position, which was on September 1st. You guys remember the show. You can go back and check the recording. Talked about opening that on, I think I opened some of that on a Wednesday, and then I doubled on the Friday. It ended up with 80 puts on the Russell. So we'll see how this ultimately all pans out. I still think that there is some downside potential, and I think we have a knee-jerk reaction to the upside. That said, two most important things that I took away from the day were the weekly close on the S&P and the weekly close on the dollar index. So let me show you those again. Here's your weekly of the dollar index. Of course, the dollar has been on just a tremendous surge. It is the first time in 13 weeks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. The first time in 12 weeks that the dollar index was down on the week. The first time in 12 weeks. Put that in perspective. I mean, that's an incredible run for the dollar index. The first time it's actually negative in 12 weeks. And it was just barely. I mean, if you think that this is a big negative, it was down 0.07%. We almost broke even. I kind of wish it would have kept positive at the close and looked great. What's important for us on this one is what that dollar index might do when it reopens for trading. So I'm going to put a line right across the bottom. You guys know the way I trade shooting stars, which is what we have here. Some might call this a gravestone doji. Pretty darn close. If you, I forgot to get Foo Fighter tickets today. Son of a biscuit, Sly. Thanks for rubbing I forgot all about that one. Dang it. Anyway, look at this dollar index. If you get a close on Monday session down below 105.95, you might see a nice little retracement here in that dollar index and a pullback. I think that it's due. Now, that said, look at the S&P 500. S&P 500 has a similar picture. Now, granted, we did go past this yellow demand zone, which I've had mapped out there. We did break down below that one, but came screaming back up, and now we're sitting at a level where you have a dragonfly doji or a hammer formation, and there's a bullish opportunity there. So, these things kind of go hand in hand on how the dollar influences the equity markets, and I think that is a very real possibility for Monday, which is why I'll probably be heavy-handed and close out that IWM trade regardless of what happens. I'll still be in the money, but definitely giving back a lot off the bottom there. So that's my overall thought process for what's going to be happening there on Monday. Now, I had a bunch of questions that came through, and I want to try to get to as many of those, but I may not have time to get through them all, but I'll try my best. So let me go through the dailies here just so we can get a wrap up for the day. The dollar index down 0.22%. There you can see we had the first 2 days of this week were great for the dollar index and then just gave back the last 3, which, all right, fine. The question is, how deep will this go? Do we get down to that 105.70 mark? Probably. I think we'll retest that one there. If that does happen, then you'll see these markets rally on Monday. Crude oil, up 0.58%, but that's coming on the heels of this just gigantic sell-off. What I don't like about crude oil is I don't see any real demand zone in here that's going to cause me to want to be a buyer of it. You have some small ones at 80. We talked about that a couple days ago. But really not that enthusiastic, at least for me anyway, on going long oil right now. Yeah, it is a holiday. Sorry, I slipped up there, Joe. So yeah, you got Columbus Day on Monday, so we will have to open up on Tuesday. Well, you'll get Sunday night. You'll get Sunday night open up, but after that, it'll just be a brief thing, and then Monday we closed. Let's just verify which one's done here. I always like to look them up because I get confused. You know, it depends on which one, but Columbus should be. Nope. No, I guess no. For some reason, I thought they were closed. No, I guess we'll be open on Monday. So there's your NYSE, and you can see there the calendar. The only next market day that's closed is going to be Thanksgiving, which will be for this year. We're 2023. That'll be Thursday, November 23rd. But no, I for some reason I thought Columbus was closed. Hell, I'm wrong. So yeah, we will be open on Monday. Apparently, that's what it says there. At least according to the New York Stock Exchange. Yep, Big Eb says market's open on Monday. Yeah, for some reason I thought they were closed, but Columbus Day. You know, why do we even celebrate it? Come on. Everyone always complains about Columbus Day anyway. If you dig into the history of it, kind of a rough celebration there. All right, so market is open on Monday. Checked with the NIC just to verify. For some reason in my head, I actually thought it was closed as well, but I guess subconsciously I had it right to begin with, which was, there you go. Tommy says the bond market's closed. All right, well, I don't even trade the bond market. They cancel culture. Huh. So I froze to you guys, and I have no idea why I keep freezing on my end over here. Looks really blurry to me, the connection that we have right now. So, all right, I'll just keep going. All right, let's go back to these charts. I don't want to keep wandering up this list here. We had a great day for gold and for silver. My silver position was very nice. I love the fact we had the great pop today. Although you look at the gold slide, a lot of people still thinking there's more downside move. I was eyeballing that 1820 mark as a bounce point for gold today. We got to a low price of 1823, so pretty damn near spot on that area of demand, which depending how you draw your demand zones, you probably could have capitalized on that nice little pop there. Now, look at SLV, though. SLV really having a much bigger jump and a rip today. Now, this isn't the futures, which is why you get the gap. Personally, I do think that there's more upside here. You have an unfilled gap that goes all the way up to 2034. Typically, gaps like that will fill over time. So I'm bullish on silver, which is why, again, I sold those puts at $19 expiring on the 20th. Most of my options right now, I think actually, yeah, most of them are expiring on the 20th. So I have a lot of different put positions open at this moment in time. The joys of trading. Here's your Russell 2000. This was a bummer for me. As I mentioned, I actually did have orders to close out my position. It got so close on the second dip, I didn't have them on the open or pre-market. When it opened, I put those orders in, and it did not take me out, unfortunately. So I'm still holding 20 puts that I purchased at 105. So I'm long from 105, which is fine because right now I think they're going for 5 something. I mean, it's still a pretty significant gain on that one, but gave back a lot on this nice volatility move to the upside. So Russell 2000, 0.92% to the upside. It does look like it wants to have a bit more of a run to the upside, but either way, I'm going to close my position on Monday. I should have done today, but I was just preoccupied. I was at lunch with Larry. That's what it was. I was at lunch with Larry. S&P 500, 1.18%, looking much better. We had this line drawn up here at 43.58. Came right back up, hit that one, and now selling off. So we've got a lot of different supply and demand pieces. I had already talked about this line right here about price rallying up there, hitting it, and then selling off. We had that happen on Friday the 29th. It was $1 over the price I thought it was going to get to. I thought we were going to get to 43.70. We got to 43.71 before selling off. Now we're right back to 43.58, which is another area of supply on this one, but we'll have to see if this holds. Of course, going into the weekend could change things a little bit. There's more to it than the man club. Correct, Tomasina. I know. Bond market. I kind of expected this to sell off today. I thought we were going to see bonds drop, but just all of the firestorm in conversation that all the talking heads and experts, including myself and Bill Addis, really felt like there'd be a little bit of a pullback in that bond market. Didn't get it today. We had an 8 basis point increase, but we finished the week at 4.8%. I saw somebody today post. It was kind of funny. They posted that, what was it? It was, oh shoot, now I'm drawing blanks. Oh, they posted that the 30-year fixed rate mortgage was at 8.5%. And I had to correct him because it's 8.5% for somebody who has a 700 credit score. If you're 800 credit score, right now that 30-year fixed rate mortgage was like 7.99. So we were just about to that 8% mark, which is interesting for me because, you know, this is almost 5% for the 10-year. And typically the 30-year mortgage is based off the 10-year. Well, that's almost 3% higher. Almost 3% higher. Actually, it's right now it's over 3% higher than the 10-year. So again, my forecast says that this is going to continue to move up. If we do get to 6% on the 10-year by the end of the year, then that means 9% 30-year fixed rate mortgages, which is what we were talking about earlier. That's Randy Newman, Slutto. Here in my car, I feel the safest of all. I think that's the song you're trying to get there. I knew that one. Next, NASDAQ. Love it. Rip NASDAQ. I actually do like the fact it broke through the highs for the past 2 weeks on the NASDAQ. We had a nice move up. I mean, the range today alone on the NASDAQ was just fantastic. We started off looking pretty ugly, down overall about 1.3%, and then from there we just ripped to the upside, which gave it a move from there of 3.41%. So you're talking an over 5% swing intraday on the NASDAQ. Pretty impressive. Finishing the day at 1.68% to 15,112. And again, respecting this 14,609 demand zone, or we'll call it support level that goes back here. Yep. Randy Newman cars, you got it. And then lastly, Bitcoin slowly moving to the upside. Now, if you guys follow Monday Morning Must Knows, I'm going to talk a little bit about it in Monday Morning Must Knows, but I'll elaborate much more here. You know, one of the big things that you want to be watching, or at least kind of have on your radar, is what's going on with Sam Bankman-Freed and his trial. Watching his mom and dad go into court, I was kind of hoping that we'd see some people egg him or something like that. Really a little bit of a shame to that family. They deserve it. But it will be an interesting one because over the coming weeks, we've already had one full week of trial. The question now remains is he guilty? Was it fraud? Was it a Ponzi scheme? And I've already emphasized my point in here. I don't believe that it was a Ponzi scheme. I don't think it was that at all. Was he misusing funds? Yes. But the funds were still there. The reason that they got caught and shut down and went bankrupt was because of what happened with other people they were lending their cryptocurrency out to, like Three Arrows Capital. So there was the problem. It wasn't really fraud. I mean, if you look at Bernie Madoff, that was, hey, deposit your money, I'll give you 10% rates of return. You're going to love it. Easy. Guarantee it. Wow. That's a Ponzi scheme, especially when the funds weren't there. With this, the money was there. It's just unfortunately because of the collapse of Three Arrows Capital, which is a result of Terra Luna, which is a result of, not Augur. I think was it Augur? I forget the name of it. There's so many damn things going on in the market. Because those imploded, it created this domino effect and a lot of capital was lost. And that's why FTX went under. So I don't think he's going to get busted for fraud. However, the interesting piece will be who gets brought into this trial. Do we see some high-ranking officials, some high-ranking politicians? Remember, he's given hundreds of millions, well, I mean hundreds of millions. I need to get the exact numbers. But he's given tens of millions of dollars to both the Democrats and to the Republicans. And I'm sure that that is a safety net that his dad told him to put in place to protect his ass if this all goes south. So there we go. I think that'll be an interesting piece going forward, not only for Bitcoin, but for the entire crypto space. And of course, you still have FTX with over $1 billion worth of Solana, $500 million worth of Bitcoin, and dozens of other coins that they could potentially sell at any moment. So creating a lot of volatility, which will be an interesting one. If the bond market is closed on Monday, is that good for stocks to continue to scream higher? So typically, it's a great question. So ideally, you want everything to be open, right? Because then you can reference one market segment against another and say, hey, well, bond markets are real strong, equity markets should be weak. Okay, we have that connection and then that correlation. Great, let's stay short equities. When you lose one indicator, and in this case, let's call the bond market an indicator, but definitely a macro indicator, you start to have a little lack of direction. So I wouldn't personally want to be trading on Monday, at least with any size, just because the volatility is going to be typically much higher because people just don't have that indicator. They don't have that guidance from the bond market. Now, what could happen is the equity markets could drift in one direction and get a nice trend going, and then all of a sudden, when the bond markets open up, it could counteract that entire move or act as a big catalyst. Bottom line is it's uncertainty. And I apologize if I sound so flippant and like, oh, well, I don't know where it's going to go. It's because nobody here does, right? Nobody here knows exactly what's going to happen when one market's closed, especially something as big as the bond market, and then they open that market up, what kind of chaos could ensue there? So I would expect just more volatility through Monday and into Tuesday. Just be careful with that. That's all I can really advise you on. And typically, you guys know my stance. When I'm approaching a market that maybe I feel really good about, I love the setup on the dollar index. I love the setup on the S&P. However, I need to be careful with that just because my feelings may get in the way. But if I'm missing a big portion of the mover of the market, right, the catalyst, my position may not be a true gain if I do make money on Monday shorting the or going long on the S&P. A lot of people about to get exposed on the Dem side. I'd say Republican side too. This is this is a universal thing, which is why I kind of like this trial. And the trial with Sam Bankman-Freed, again, we don't know what's going to happen. My guess is if I had to put money on the line right now and wager with you what would happen with Sam Bankman-Freed's trial, I think Sam Bankman-Fried will get off. He's going to pay a fine because he misappropriated customer funds. He commingled customer funds, and that's not allowed. Although he could make the argument that we are not a traditional brokerage firm and the guidance wasn't there for firms like ours. So what I think will probably happen is at the end of all this, it's to be a long, lengthy thing. His family, who are lawyers, I'm sure has connections up on high up to help him out. They've been paying off tens of millions of dollars to politicians on both sides to cover their ass. They'll probably get a little slap on the wrist, pay a small fine for commingling funds. And it would not surprise me to see that he is not banned from the industry, that he can actually go back and be in this industry. I think he's going to pretty much get off scot-free except for a fine. And who knows how much that fine will be, but I don't think he'll go to jail. I really don't. I mean, I kind of hope he does. Let's discourage people from doing things like this, but when you pay off that many politicians, you get a lot of people sitting on your side and go, okay, yeah, well, you're okay. Hey, Lori, good to see you. Welcome back. All right, let me, so I ran through those things. The other piece that is a little, I was going to show you the, here we go. So here's that 30-year and the 2-year. So we talk about the inverted yield curve. I think this one's really interesting because it's almost closed the gap, right? We're only 11 basis points inverted, which I'm going to call that flat. I think when you get to 10 basis points difference, I'll call that a flat yield curve. We still got a little bit of a ways to go here with the 10 and the 2-year, but boy, we could very quickly see this one get closed. And again, I brought this up with Bill Addis yesterday. This is my concern, that if we get the yield curve to go back to normal, remember the short end is not going to change. It's the long end that's going to change. That means that long end has to rise higher than this one. If it keeps getting higher, keep your eyes open for more banks. I wrote an article for Bar Chart a couple months ago saying there's more pain ahead for banks because of exposure to different areas. This could make things much, much worse for those banks. And I don't know which ones to target. If you look at something like XLF, we could look at the ETF for financials right now. It's gotten crushed. I mean, it's come down from 35 to 32. So we'll call that a 10% slide in a period of 2.5 to 3 weeks. That's pretty significant. But if a couple more banks go under, like we saw with Silicon Valley Bank and Signature, I think you're going to start to get a few bigger names, maybe bigger names, and that could create turmoil in our financial markets. So I'd be very cautious of that. The higher that yield gets, the worse it puts those banks in, worse position it puts those banks in. Now remember, part of the reason that Silicon Valley Bank and Signature Bank went under is they were taking customer deposits, they were buying long-term bonds, the 10-year, for example, which they locked in a rate of, let's say, 1.5% back in 2020. Well, all of a sudden, as we've seen, the price of those bonds has dropped significantly. So let me see. I don't know if I have, do I have the bond futures on here? I don't think I do. Here we go. So this is the price of those bonds. And you'll notice that they were up here at 117, now they're 106. I mean, this is the value of those bonds dropping. So if they are forced to sell, let's say that the customers from these specific banks decide, I'm just going to move my money out, and now this bank is forced to sell these bonds, they're going to be selling them at a steep discount. And that is going to potentially result in significant losses. So hopefully we don't get a run on the bank. If we do, it could be pretty ugly for some banks going forward. So keep your eye on that one. Yeah, the FRC route, it's no longer FRC, it's FRCB. This was a similar picture. And I don't think that we're done. When I asked this question to Bill on yesterday's show, it was kind of interesting. I said, I said, do you think this is going to hurt some banks? Do you think are there going to be potentially some more that go bankrupt? He's like, yeah, absolutely. It's like, oh, absolutely? I'm pretty confident we'll see some banks have some issues, but I don't know if I could say absolutely. But if it keeps on raising like this, it just makes sense. It's going to be a problem for them going forward. It also puts Schwab in a bad position, correct? Yep, it does. And if you look at some of these bank stocks right now, it's, in my opinion, it's pretty clear. Here's Bank of America. Bank of America has just, it started looking good, and then all of a sudden, over the past couple of months, has just gotten weaker and weaker. Here's Charles Schwab. Same thing, right? Charles Schwab had a nice little trend going, was looking pretty good, made it all the way up to 68 bucks, and all of a sudden, drifting lower and lower and lower. There we go. Yeah, Bill said that on the show yesterday. You always have the bellwether, the big guy, JPM. Even they are down. They were up over 158 and currently down at 145. So we're definitely seeing a pullback in financials. We could go on and on and on. Let's go look at Goldman Sachs. It doesn't look very good for financials at this moment in time, and even the ETFs. Let's go XLF yet again. I had this line drawn. I'm not exactly sure why. Oh yeah, because that was this baseline down here at 32. I think I wanted to sell puts at that level, and I didn't, unfortunately, because I'd be happy with that one. So, Lori, why is the bond market? It's Columbus Day. Columbus Day. So I think that's the last little pieces I want to cover from that one. Lisa asked this question, so let me dive into this one. I'm going to make sure I wrap up within another 15 minutes or so. Says, you go over plenty when you spend time with us, but I was wondering if you could replay your thoughts when looking at IWM chart and making a decision to buy puts. I'm pretty good with zones, and I usually have the same zones you do, but the thought process is where I may need some help. Okay. Another little sip of the whiskey here to help with that thought track. Okay, so nothing is ever perfect. And, when I'm making trades, I'm looking at the bigger picture. Typically, I'm looking for specific trade setups that I like. I like double tops. I like when things come back into overhead supply. So, yeah, the equity market's open and the bond market's closed. If you look here to the Russell futures, right, I'm going to go to right here. Let me just take this line off just for now because I think it's distracting. I'll put two lines on here just to show you what my mind is thinking. Actually, I'll just do a fib retracement level because that way I'm looking at this area right here. Okay, that was what I was looking at. That's a horrible representation. I'll just do another yellow box. It's just the yellow box on top of yellow box looks really clunky sometimes. So I was looking at that little yellow box. Let me change the color. Okay, I'll change this color just so we can have a better visual of it. And go to text, coordinates. Oh, I guess that's transparent yellow. How about transparent? I'm colorblind, whatever that color is. There we go, at least see a little contrast. So at that moment in time, I was looking at this level right here. Okay, so I'm looking for potentially shorting a pullback into overhead supply. That was my thought track at the time. Thinking to myself, all right, I think that this might be selling off. I think we're going to retrace back up an overhead supply. And of course, some of you would zoom out here and say, well, we're still in an uptrend, Merlin. Okay, I'll give you that. However, I also went into seasonality, and you know that one of my big things is I believe Stock Traders Almanac, when I read their statistics, and shows that the month of September is historically a negative month. So right away, I'm already thinking, where's a good point for me to start building a short position for the month of September? And I think I was very clear on this program. I said, I plan on staying short September and October. And I said, September's historically a negative month. I'm playing the statistics. It's not like historically it's down 10, 20, 30%. But even if the overall market is down, let's say 1%, well, if I'm short that time and I've got position size properly, 1% is a nice rate of return for a month, especially with the right leverage and using options or futures. So I came in with the mindset of I'm looking for something to short, number one. Number two, I believe in the short because of the seasonality of markets in September and October. I also said on the show before on September 1st that I do think that October could have that black swan event. I feel like we're way overdue for it. I think this huge surge in bond yields is causing a little bit of chaos and stressing our markets out. And I do think something's going to snap. I don't think that the markets are going to implode and we get this 5-year recession. But do I think that there could be a disconnect, a black swan event where all of a sudden over the period of a couple of days the market could drop 5, 6, 7%? Yeah, I do. Maybe not music to anybody's ears here, but markets go through those phases where every now and again, it just does something that people just least expected it, and it snaps, and all of a sudden, people freak out about it. So that was going into it, my mindset. So what happened? I actually had multiple levels on this one. I forgot exactly which one, but as it came into this overhead supply, I ended up shorting. I actually shorted the day before. I'm not sure, but I wanted to short as we got to it. I knew I would scale into the position, so I ended up shorting going long 40 puts. And as it came in that supply, I went long another 40 puts. So that put me at 80 altogether. So and I've just been holding those and expecting it to keep dropping. And you guys remember when we talked about it breaking this neckline, this was where I was like, oh damn, here we go, right? So now I was expecting this to keep dropping, and I kind of targeted out different levels. Earlier on in this week, I closed half of my position when we broke these lows right here, or we came back down on these lows, on Monday. And I was like, I just want to take some money off the table. Granted, I would have made a lot more because the panic and the premium just soared right here, but it's okay. And I don't think that's what you're asking about. You're asking about the zone itself. So my zone was based off of this kind of four-day sideways action. Those of you who are core strategy people know much more about it. I'm not going to go in depth on the reasons and justification for it, but that's back to August 11th and August 14th really are the two candles that caused me to want to go short the Russell. And the other one that I also shorted was the SPY, and I did that right around the same time. And let's go SPE. Go up here to the S&P futures because that one stopped me out. It was right in here. There was overhead supply. It had this shooting star. And I think I shorted when we broke down below the shooting star. So I wanted confirmation. I waited till I got confirmation, and we got that right. Right. This is the trade setup, and it was very similar to what we saw with the Russell. The S&P set up with a shooting star on Friday the 1st. And I don't remember exactly. I have to go back and look at my trade statements, but I think I actually shorted on that Friday. If not, I think I made it clear on the program. I was waiting for it to break down. That means the next day I ended up going short there. So open up a short position. What's unfortunate about this one is it ripped up over the next couple days, and that one right there on the 14th of September stopped me out. And of course, in hindsight, you're like, dang it. Whatever, that's fine. I took a small loss. The gains I had on the Russell trade can obviously offset every single penny and multipliers more of what I would have lost on that S&P or what I lost in the S&P. So there you go, Lisa. That's just kind of my overall mindset, and I try to articulate that with you guys, just kind of bigger picture. Again, I don't want you guys to be taking trades that I'm taking just because you think I'm going to be right. I'm going to be wrong a lot. It's okay. If you take anything that I talk about, you got to do that at your own risk, right? I'm not a financial advisor. I'm just walking you through what I'm doing. I probably need to put a disclaimer on this show, as everybody else I see that has a show like this does, so I should put a disclaimer on here. This is for edutainment purposes, I guess. So there you go, Lisa. Hope I answered that question for you. Let's see. Another question that came through from El Jefe. He says, is it possible if institutions will have a hard time purchasing Bitcoin for their holding position that they might choose to bail in the program? Nope, not a chance. Not a chance. Here's why. It may be difficult. So let's say we get ARK, BlackRock, Fidelity, and Grayscale. That seems fine. Those four get their Bitcoin ETFs approved the week of October 16th and 17th, which is the next big deadline. If they get approved, for them it doesn't matter what the price of Bitcoin is. They don't care. If Bitcoin's $1 million a coin, it doesn't make a difference to them. All they care about is that people out there want to buy their spot Bitcoin ETF. So what happens is, right now Bitcoin, trading at $28,000. If all of a sudden these massive four institutions have to buy Bitcoin, they're going to go out there and buy from a limited amount. Remember, there isn't infinite Bitcoin. Right now there's 20 million in circulation, and a majority of those aren't on an exchange, meaning they can't actually buy those. So what's great about this is those four firms are going to go to exchanges, go wherever they can to try to buy this Bitcoin. And if the retail investor, right, your mom and pops, the people that are afraid of Bitcoin but will buy an ETF because it's on the stock exchange, they're going to now go and buy that ETF. Great. Go buy the BlackRock Bitcoin ETF. You know why? Because BlackRock now needs to go find that Bitcoin, which is an extremely limited supply, and that will drive the price up. So it doesn't really matter to the fund manager. It doesn't matter to BlackRock what the price of Bitcoin is. All they care about is that people buy their Bitcoin ETF. Makes no difference what the price of Bitcoin is. It will not deter any of them. Matter of fact, it's going to encourage them even more. As soon as they get green lighted, any firm that has to be buying Bitcoin is going to gobble up as much as they can, right? Or at least lock up those channels to get as much as they can because they're going to need it. If you look back at when, can anybody here, I am not going to have time to research this one, but I believe that the GLD, gold ETF, I think, if my memory serves me right, you guys can help me, I think it was November of 2004 is when that ETF came to market, right? So GLD, the one we use as a proxy for gold here, everyone's probably bought it, used it a lot. That one was created in 2004. And when that happened, the family, the parent company of GLD had to go out and buy physical gold because that's how it's structured. Okay, if they did that, what do you think was going to happen to the price of gold? I mean, if you look at GLD today, let's go look at GLD. Right, here's your volume. This thing traded 9.94 million shares today. That's a lot of gold. A lot. And there's a huge money in this. So, when this thing surges, they have to buy more gold, etc. Let me go back and show you November. I'm pretty sure it's November. Some of you might want to check. I'm sure somebody over here could check. I think it was November of 2004. Oh, well, there it is right there. Was I right? Yep, November of 2004. GLD was trading at roughly $44. And look what happened. Yeah, it sold off a little bit, but then all of a sudden went through this huge, it went from 44 to 72 in a year and a half. And then all of a sudden, it just kept on going and going and going because gold became much more accessible. It became this vehicle that if you're an average Joe, you're not going to go to the numismatist and buy gold coins or gold bars, right? You're like, oh, I can now have exposure to gold by buying GLD. And back then in 2004, most people were not sophisticated enough to be trading futures. Futures have really become mainstream. Thank you, futures trader. Verified for me. I appreciate that. Most people weren't sophisticated enough to go buy gold futures, don't even know how gold futures work. So when GLD comes to the market, people are like, I'm going to buy that. And it started to get added to people's long-term portfolios, and more people bought into it. That did wonders for the price of gold, in my opinion. I think Bitcoin's going to be no different. And I think it will be different in the case of, I think the move is going to be more extreme. Why? Because theoretically, there is a limit on gold, but we have no idea what that is. Empirically, we know exactly what the limit of Bitcoin is, to the exact one. And we know roughly how many are lost, right? Around 5 million have already been lost. That means that when BlackRock gets approved, they're going to have to buy. And if there's 20 million created total right now and 5 of those are lost, that means there's 15 million. More than half of those are in cold storage by people like me who are going to hold it. It means that prices are going to surge. And I think you'll get a nice big rally in cryptocurrency because of that one. So, Jeff, I don't think in any way, shape, or form they're going to back away from their decision to start a Bitcoin ETF. It's a gold mine for them because of the transaction costs they'll be charging. They're probably going to get, 1.5% transaction fee for a Bitcoin ETF? Oh yeah, trust me, they will be happy at whatever. If Bitcoin was $1 million a coin, doesn't matter to them. They'd still go public with the ETF because now people can buy Bitcoin easily, conveniently through a traditional brokerage firm, and they will capitalize on that. So that's part of the reason I'm so excited for these markets going forward. All right, the next one, Andrew says, Target dropped past your buy price of 105 today. Did you buy it? No, I did not. I sold puts. So by selling puts, for those of you who might be new to it, selling puts basically says, I'm willing to buy it if it gets to 105. So let's look at Target. It did break down below it today, but my options expire in another 2 weeks. So not this coming Friday, but the Friday after that. So I've got some time here. Not the best position for me to be in at the moment, to be honest. It doesn't look that great. But here is Target on the weekly. Let's go to the daily here. It's a lot of volatility on it today. We hit a low price intraday of 102.93. Ouch, not good. I checked my account. Now, if it's below 105, right? Remember, I sold the puts, which basically obligates me to buy it at 105, or if it's at any price below that. At some point today, if the person that bought that put from me wanted to, they could have exercised this option at 102.93, and I would be forced to buy it at 105. I would have been out. I would have lost money on this one already. But it didn't happen. I didn't get exercised, okay? If it gets to expiration, meaning we go forward another 2 weeks, and it gets, I'll put a little vertical line where that 2 week mark is. If by this vertical line right here, which is October 20th, right there, oh, that's horizontal line. I got to learn the difference between horizontal and vertical. If it closes below this little cross right here on the 20th, I'll automatically own those shares at whatever price it is. It's going to automatically do it, right? So anytime, at any time between now and October 20th, if it's below 105, there is the potential those shares could show up in my account at random. Not worried about it. Again, I told you, I'm okay owning Target at 105. I know Tom's like, no, I don't like it. Don't do it. Perfect. That's fine. That's my market's work, right? Tom, short it if you want. That's okay with me. I think I'll be fine at 105. If anything, I think it's going to drift sideways, and a large part has to do with, we're coming into these areas of demand that go back into 2020. Now, there is a much deeper level right around 91, which would be a better place in my opinion, but I was a little bit aggressive on this one, and the premium was nice and juicy. So, Andrew, no, I did not buy it. I not really have that choice. What the right term would be, did you get put the shares would be the term that you're looking for, because I have committed myself to buying them, but it's up to whoever bought the contract from me, right? Would I have bought it today? I guess I probably would have if I wanted to, but I have the option. I collected premium on it. Let that premium keep deteriorating over time, and hopefully by the time we get to next week, in 2 weeks, I guess you guys answered this question for me. If you had this chart right here, and you had the 105 strike prices on target, and right now it's at 105, what would be your best case scenario? What would you like to happen by the close of Friday, October 20th? What would you say, this is what I wish would happen? Because we could have difference of opinions here. I'll give you a second to type it in there, and then I will give you my answer. But what do you think, in your mind, would be the best option for you if it went to October 20th? Where would you want to see price close, and why? I'm just curious. All right, let me take another sip of whiskey here while I answer that one for you. Why is purchasing the real thing better than purchasing Bitcoin futures contracts? Because futures contracts are a derivative product. You don't have any physical ownership, right? There is centralized control. There are issues with the people that are making the futures contracts. Plus, you're paying commissions and spreads, and there's deterioration and contango and backwardation. Those kind of factors are, I guess to me, a deterrent to the futures. Owning the physical thing is, I own it. Right? Regulators could come in and do something with Bitcoin futures trading, or some wonky thing could happen. I own my Bitcoin. It's right here. I have access to it. No one's going to take it from me. I own it. And because I own something that's scarce, potentially going to go up over time. Plus, remember, your futures contracts expire. You have to keep rolling and rolling and rolling, and therefore you would suffer from backwardation or contango. All right, let me see. Lisa says, close at 105.01. Big Eb says, close at 105.01. 105.01. Yeah. Right. If it closes above 105, then I keep all the premium and nothing happens. I would actually be okay if it closed at 104.99. Right? Just close right. I'm okay being exercised that, because what I'm going to do the next day is I'll probably sell those calls at the money at 105 anyway. Well, it depends what the situation is. But if those expire on a Friday, and let's say they expire at 104.99, I've now put the shares, and I now own Target. Well, if Monday morning that thing opens up at 106, well, I'll sell the 106 calls, and I'll collect more premium. Or maybe sell the 105s, depending on what the premium is. Or if I think it's going to rally, I might sell the 110s and let it run. So the only thing I don't want to happen is I don't want to see this crater. I'd hate to see TGT get all the way down to $90 by the 20th. And could it? Sure. Look at the trend. I am absolutely catching a falling knife. This is a dangerous trade for me to be in, but I'm okay with it because I do like the prospects of Target over time, although you look at our economy right now, there's arguments that we're going into a recession. Good news is it's not a big one. I only have 5. I think I have 5. Let me just check real quick, make sure you guys know what my position is. I don't like misinformation here. as the tagline says, real trades, real money. So I guess I should disclose the realness of it. I have 5 of the TGTs. So 5 of the 105s expiring on the 20th. I do have 20 of the XLUs expiring on the 20th at the 54 strike. That was another good one. I like this. I'm definitely bullish on XLU at this point, or utilities. Great move up today. Hit $57. Again, my strike is down here at 54, so looking pretty good on that trade right now. All right. I wish we would close higher than my strike, so the stock is not put to me 105.01. There you go. So the majority of you saying, I want TGT in that situation. I want TGT to close at 105.01. Sure. That would be great. And I'm actually okay if it closes slightly below that and I get put the shares. Fine with me. If I'm in there at 104.90, 104.80 even, I'm okay with that too because I collected enough premium. I think the premium I collected, if I'm not mistaken, I think I'm at 115. So my average price is something like 103.90, 103.89. So fine. All right, close. I have 54 strikes on XLU. Did you sell the puts, Lori? November 15th, earnings day for Target? Yeah. And again, that's one thing I have to be careful about, is that November 15th, because the earnings, as we looked at, have been slowing. Notice the most recent one was $1.80. Before that, you had $2.05. Before that, you had, $1.89. Before that, you had, $1.54. Oh, interesting. It actually went up a little bit, but now is drifting back down. We'll have to reevaluate, and I most likely don't want to be holding Target during earnings. You guys know my thoughts on stocks during earnings. Kind of a little too risky for me to do there. Let's real quickly look at Swasi asked about natural gas the other day. And natural gas had a real nice move today. Here is your natural gas chart. Over the past couple of days have been great. And we talked about it breaking above that 3. You kind of need to have a convincing break above it. And lo and behold, the last 2 days have just been absolutely fantastic. I will probably have I have UNG. I'm long UNG and I have calls against UNG right now, which will probably take away my UNG shares on the 20th. We'll see what happens. Hey, Big Eb, have a fantastic weekend, my friend. Cheers. Do something fun. I will see you in a week. Remember, no shows next week for me. Yeah, Lori Minor as well for the 1020. Yep. All right. Let's see. I think that was pretty much it. There was a longer question. I don't know where I put it, asking about strategy and tactics from you, Jeff. I got to figure out how to do that one. I've given out a lot of golden nuggets and secrets and kind of things that I do. I need to find a way. Not to find a way, but I have to figure out if I want to do on a kind of a paid channel, and I think that's where I would disclose a lot more of that type of information and really the exact things I'm doing. When I present this to you guys, I'm showing the real trades, I'm showing the exact executions, I'm showing the actual strike prices, letting you know everything detail about it. But some stuff I am leaving out because I can't give you everything. There should be a fee for that, right? Yes, Pepe, no shows. Next week I've got no shows because I will be teaching a class. I'm teaching all next week in Irvine, so I will be out of commission. No shows at all. I'll be teaching until 3 p.m., so show will be done. All right, let me wrap up here. As far as the economic calendars go, Monday, you really don't have anything that's that important. I will bring up the calendar here so I can wrap up. I got to get on the Don Franz show here, so I'm going to end this one for us. If you look at the 9th, it says bank holiday. All right, for Canada and for the U.S., but there's nothing really going on here for the U.S. Most of the stuff starts on Tuesday, but we do have a lot of stuff happening Wednesday and Thursday. Can you share the link of the show you will be participating in? Yeah, let me see if I can find that one for you. I know it came up on some people's feeds here, but let me see if I can bring that one up for you. And then earnings-wise, nothing, right? It's really boring next week until you get into Friday. Friday is really where all the fun begins. Let me see if I can bring up the YouTube channel. A paid channel should be only for crypto. Yeah, my commute's going to suck, Dave. It's short. Oh, okay. He's already got the link there. So let me copy this link over for you guys. 1 second. Huh, where is it? That was weird. I'm trying to get you to it. There we go. 1 second. You'll need to wear shoes and pants. All right, so here you go. This is the link to the Don Franz session, which I'll be jumping into. I'm literally just got to wrap up here so I can go join that one. I need to get a goatee going. It's looking pretty burly over there. I'm saying the other show you because with Don. Yeah, Don Fron. So there's the link to that one. And I'll be over there in about 10 minutes and we'll start there. Okay, that's going to do it for me, everybody. Hope you enjoyed. I will miss you next week. That's for damn sure. I don't know what I'm going to do with myself having not doing a physical class here. Oh, it's crazy. I don't think I've really taken a full week off other than be like deep vacation. Jamaica, I took a week off too. But if you guys have comments, questions, feedback, things you want me to discuss in the near future, let me know. Give me some show ideas, topics you want to cover. You can do it at TraderMerlin@gmail.com or go to my YouTube channel, put your comments out below any of those YouTube videos, and I will get to all that and hopefully have some new guests for you starting in a couple of weeks. And that said, thank you guys so much. Cheers. Have a fantastic remainder of your day. Do something fun this weekend. If you have the time, jump on over to that link I put in chat, which will be the Don Fron channel, and we're going to do, maybe an hour or so on that channel as well, talking markets and wherever it decides to go, wherever you lead us. Take care, everybody. Have a great weekend. I'll see you later.